The Fed has been rushing to expand its balance sheet, nearly $500 billion of expansion in a few short months, faster than any of their previous programs. They're not alone, of course. We have seen the ECB, the BOJ, and all of the rest expand their balance sheets as well. Currently, the major players are pumping in $100 billion per month in formal QE. What needs to be acknowledged here is how can the central banks ever stop printing? The truth is, they can't. And that's why you came here for the truth, so let me unveil that for you. You're not going to get this type of information in the mainstream media. They don't want to tell you what's really going on. That's why you tune in here. Sometimes it might seem like bad news, it might seem negative, but hey, there's a lot of kitten videos out there that'll cheer you up after this. What I want to get into is the economic news, show you what's going on, and of course, what's happening with the central banks. I always cover the central banks. Anytime I find any data related to central banking, I bring it to you. That is first and foremost. And why? Because it has the most direct impact on what's going on in the stock markets and the financial system. I get comments every single day saying, stop covering what's happening with the Fed. And those comments there are, of course, stupid. I don't care. I'm going to say it. Because what we need to acknowledge is that these two are completely correlated. More on that in just a second. But let's look at what's happening with the Federal Reserve's balance sheet. We can see that just like with the ECB, just like with the others, as soon as the financial crisis came in, they printed a whole bunch of money. That pumped it up, that got things going again, and they officially declared the recession to be over only a short period of time after it began. We know that there was much more to it than that. We saw so many statistics that were actually weakening into 2010 and beyond. Then as 2011, 2012 approached, we had some serious issues start to ignite in Europe. The Euro sovereign debt crisis was just massive, and it's still going on today. The issues were not resolved from that point. The issues in the United States were not resolved from the financial crisis, and we are still being burned today because of that. They tried to set up the EFSF in Europe. They tried to do the ESM after that, neither of which resolved anything. Then they had to reduce interest rates all the way into the negative. This is terrible, and you know the result of that. It's looking extremely weak right now in Europe. Then you see what's happening with the Fed. They have expanded their balance sheet. They pinky promised that they would be able to decrease their balance sheet. I've covered it so many times before, not going to bore you, but Janet Yellen talked about this. Ben Bernanke talked about this. It's just temporary, okay, everyone? We're going to do this. It's an extreme measure. It's an emergency. It's temporary. Oh no, wait a second. The problem is persistent. We're going to keep it here as long as we need it, and we will expand if necessary. Things really do change. If you see the general investor sentiment, they will never, ever accept a reduction in the balance sheet that is any amount of meaningful. Take a look at what they did. They're already approximately halfway back to that point at which they brought it down in just a few short months. They're printing an excessive amount of money between the repo operations, the term operations. We're going in and we are expanding this balance sheet at a rate we have never seen before. It's going way faster than all of the other operations they did, QE 1, 2, and 3. And there's no way to turn it back, and they don't want to. This is what they are trying to do. They're trying to actually expand the balance sheet beyond where we had before. And in the next few weeks, surely we will see this go beyond that 4.5 trillion mark that was brought to us a little while ago. Now, this is why I cover the central banks and think that they are the most important factor when it comes to what's happening in the stock market in particular, but also with the financial system in general. I've shown you this multiple times, but just want to reiterate as often as I possibly can as we get the new numbers that come out. The weekly change in the S&P 500 is directly correlated with what we see with the balance sheet of the Federal Reserve. There's no doubt about it. You can see it for yourself. If you cannot see this, I can recommend an optometrist to check out your eyes if you'd like that, of course. But here it is. It's very clear. Anybody who's not really seeing this, I mean, I don't know another way to say it. There's something wrong. Take a look at it and read it and weep, quite frankly, because this is real. This is something you can't ignore. Now, this here comes from Morgan Stanley, and what they put together is essentially the fact that the Federal Reserve's balance sheet is so critical to what we're seeing in the S&P 500 in the stocks. And they show us at the very top, the S&P 500 lows in September and October coincided with the Fed's balance sheet injections. And this really went into a new level, of course, as time went on, and they were able to turn that around. They expect that the S&P 500 will exceed 3,500, and there's no doubt that it can. As long as you devalue that currency, you should be able to push it up as high as you want. Venezuela being one extreme example of that. This is really key here. You could see the Federal Reserve, the Bank of Japan, and the European Central Bank are expected to buy almost 500 billion of debt this year. That's billion pounds, and nearing 1 trillion by the end of 2021 through the experimental and controversial policy tool, according to estimates by Nomura. Now, what this shows us is that all of these central banks are doing basically the same thing. Different levels at different times, different strategies here, but ultimately it's QE. It's QE under different names, but what they are doing is printing money out of thin air and they're buying something. Sometimes they buy stocks, sometimes they buy debt, sometimes they buy toxic assets. Doesn't really matter. They actually, in Europe, I think it was crazy because they, under their CSPP program, they were buying up corporate debt. And this, in effect, as far as I'm concerned, is bailing out institutions directly. They're buying up their debt. So these companies, they can basically be bankrupt and they're just being bailed out behind the scenes by the CSPP program. And that shows us how weak things are. I provided a list. I think it was UBS, maybe I'm wrong, but I had a list at some point and I showed it here on the channel before in more than one video where they had this huge list. And I think it was UBS and then they provided that to Bloomberg or something like this. But what we were looking at was this huge list of all the names. And I just looked down that list. It was every company, that I would know coming out of Europe, they were on that list. Whether it was BMW and basically everything else, they were there getting money from this CSPP program. And what does that tell you? You don't get the money. You don't get a single dime. And you think somehow that them printing money out of thin air, giving it to these big corporations is helping you? Oh, well, the stocks are going up higher. Look, you're not going to see any of that because they're going to wipe it out in due time and they're going to shake all these investors out. That's what occurs every time. This is intentional. This is not for you to play in. They don't want regular people in these unless they're in their 401ks, their pension funds, because they largely have control over that. When you have these corporations, whether it's Robinhood or whether it's, Fidelity or Vanguard or anything else, they sell a product. Even if it's you buying stocks, they are the ones who are making money off of it. They have to be the biggest money maker in the scenario or they're not going to do it. They have to increase their corporate profits. And you think that they're doing you a good favor. They're being nice by having low fees and so on. You got to look into the fine print. You got to understand why they're in business and how they can persist in a tightening market, in a market that is getting more and more difficult because of all the competition, because of everything else. There's so much more going on here that people simply do not understand. There's more in this article here that touches on a lot of interesting things down at this point and below. If you have time, check this one out. Links will be in the description. Northman Trader said something that I've said so many times before, but I wanted to bring it to you because it's concise. Anyone ever see an announcement by Jay Powell or the Fed that their plan is to expand the Fed's balance sheet by $400 billion in 3.5 months? No, that's because that statement doesn't exist. The Fed is engaged in willful miscommunication with the public. Everybody knows this. At this point, I do believe, except for investors, they don't care anymore. That to me is very strange. Because typically, before 2008, there was some credibility to these institutions. And now things have really changed. It's just shut up, print your money, and save the day. But there's some hearts that could be broken next time around. And we're going to have to see how it goes. I don't really know the story, but certainly you could say that some events may repeat themselves and we could be in for a wild one. I thought this was absolutely insane. This one here, if I'm not mistaken, was sent to me by a subscriber of mine. In recent months, Goldman has begun to mimic repo trading using derivatives known as total return swaps that carry lower capital requirements than regular repo trades, according to people familiar with the bank's shift. I'm going to dig in a little more. I'm going to try to find some details about this. But are we talking about more derivatives? Is that what the world needs right now? And looking at this, it's garbage to begin with, and yet they're going out creating derivatives of it. I need to know the details, but just on the surface level, I mean, this is nothing but garbage. File it under G, it's garbage. JP Morgan, meanwhile, has been encouraging its clients to use so-called sponsored repo deals, where a clearinghouse sits in between trades and allows dealers to net transactions off against each other. I don't know what the hell all this mess is, but it is never going to be a good thing once you have a disruption. Look, when the market's running fine, you have all the reason to put your money in, dump it all in there, mortgage your house a second time, sell a kidney, why not? But when things go bad, you're going to be hurting. That's the unfortunate part, and people don't know what to do at that point. Infotech drove 32% of the S&P 500 return in 2019. You can see that for yourself here on the chart. It's unbelievable to see how narrow this really has become over the years. Despite the growth in many of the other stocks, it's nothing even close. And why? Of course, we know that stock buybacks have been the primary reason. Underneath that, yes, we have the central banks, that's clear, but of course the stock buyback, they've been the primary buyer of the shares. You could see the chart here, S&P 500 buybacks by sector. This is going back from 2007 up until 2019, and information technology by far and large, 2018 and 2019 has been the number one. That has contributed to what we have seen. Superstar firms made the largest positive return contributions. This is a list showing us all the names you know at the top. Apple, then Microsoft, then Facebook, then Alphabet, and Amazon, just a couple below, in addition to your friends at JP Morgan. All the numbers listed here as well. Just wanted to show you that because it is connected. This was some data that I found. U.S. recessionary manufacturing activity, share of manufacturing subsectors contracting, and that has grown to a level we have not seen since the financial crisis. There have been so many, whether we're looking at the ISM or any of the shipping gauges that we have noted here, they have looked extremely weak, and it's not on the short term. It's been going on since 2018. It's been dragging on and dragging on. Some of them have started to turn up, but that trend remains to be seen. And of course, I'll keep giving you that data. A lot of people don't really understand what it's all about, but surely I will be able to break that down for you as well as I can. This is the price of gold. I thought it was interesting. After all the events that have been in the news recently, you know what I'm talking about, we had gold peaking out. I think this is right here, this level, 1613. This is extremely high considering where it's been over the past few years. But of course, everything is just fine, and the price comes down quite a bit. It's sitting at the time of this recording, 1557. It has come down a lot. And why? Well, everything's fine now. Everything is totally fine. Apparently, they didn't see the new information that came out in the news saying that, actually there was another thing that was hit. I can't say any more than that on this video, but just look into it for yourself. There's some more things happening. Certainly, it's not over yet, I believe. I hope it's over, that's for sure, but regardless. We're looking at the Baltic Dry Index sinking down to a level hasn't been at in a long time, 773. Now, this shows you weakness in this one particular indicator. You can't just say, well, the Baltic Dry Index is bad, therefore everything's bad, or the Baltic Dry Index is doing good, therefore everything's good. That's not a good way to do it. I'm showing you this in comparison to so many other indicators to give you a real idea of what's happening. And what we see with the auto industry continues to get worse. German car production drops to 23-year low on waning exports. Look around the world. It's not just because of a slowing economy in Europe, or maybe it's just Germany's problem, or it's one car company or another. This is going on literally all over the world. And the excuse has been, well, they're going to electric cars, therefore they're going to have issues right here. I don't know about where you live. I've said this many times before. I don't know about where you live, but electric cars are still making up a small percentage of the total. And while, yes, yes, I'm sure that's going to grow over the next few years. That is just a small piece of the pie. And I don't know, when they talk about the silliness in these articles, I mean, the people writing them have to be just in desperate need for their job, and they're willing to lie or just straight up ignorant. I don't know what it is. That's all for this video. If you found it informative, hit that thumbs up button. When you hit the thumbs up button, by clicking a button on your screen, you are supporting me. That's it. That's all you got to do. I appreciate it. Thank you. If you want to learn how to actually make money, this is how you do it. It's a step-by-step guide for selling on Amazon. I created it for free for you to learn, the AmazonGPS.com. If you want to learn about the financial system, I created these 2 books to make it easy for everybody to understand. There are no 2 books like it, that's for sure. I teach it in the way that I would in these videos. It's very relatable, very easy. Check it out, link in description. If you want the audiobook, themoneygps.com. This video is so important. I covered a lot in here and I want you to check it out. So click on this and I'll see you there.